Please leave a message after the tone.
Dan? Hey, it's Bill at Bayside. Sorry to bother you, but our insurance carrier just sent a non-renewal notice. Non-renewal? They're citing the building's age and, I don't know, coastal exposure? Now Janice in 3B says she can't refinance because we're on some kind of blacklist? Is that even a real thing? We thought we were okay on reserves, but maybe we weren't looking at the right things. This feels like it's spiraling fast. We need someone who understands this mess. You always know what to do. Any insights?
Hello, welcome to Pick Up, a podcast hosted by Capital Bank. My name is JJ Kaye. I'm the CMO here at Capital Bank, and today I'm joined by two very special guests. I have Dan Selzer. Did I get that right? Selzer?
Yep.
Yes.
No T.
No T. No, it's not Seltzer. It's Selzer.
You got it.
Our head of HOA banking for Capital Bank, and all the way from, and Will, you're down in Florida, correct? Correct me if I'm wrong.
Yeah, my office is based in Fort Lauderdale. Yeah.
Okay. We got Will Simons, president of Florida Southeast Region for Association Reserves. They are a leading provider of reserve studies in the nation. So very excited to have both of you on the pod today. It's my first time saying on the pod, so I'm very excited.
Well, thank you for having us.
Awesome.
Yeah, great to be
Awesome.
with you guys. Thank you.
Yes, no, we're super excited. So for those of you who haven't listened to Pick Up before, this is literally the podcast where we try to answer those burning questions that, businesses and business owners are facing in specific industries. And today, if you haven't figured out, we're talking about HOAs and condo associations, and the pickup call that we're dealing with is the community blacklist, which sounds kind of spooky, sounds kind of scary. We are Halloween is right around the corner, so I think it's fitting. But I want to just kind of set the table a little bit so that everyone who's listening understands what we're going to be talking about. And today we're talking about a crisis that many condo associations are facing, which I think you're going to hear from Dan and Will on. And one that's heightened in areas like Florida, where new laws and climate change are combining to make these condos uninsurable, putting them on the blacklist. So with major players like Fannie and Freddie. And obviously this is causing major headaches for board members, condo owners, condo associations. But I think, the purpose of today is really to sort of get at the heart of what can maybe start to mitigate some of the concerns here. And I think it's this thing that Will specializes in, which are reserve studies. So before we get to the solution, I think we want to have a little fun first and kind of talk a little bit about sort of like what's going on. And Dan and Will, when we first spoke, Will, there was something that you said which kind of struck me like a bolt of lightning. It was a little bit of a provocative statement, but I think we like to have fun here. You said this is a terrible time to be a board member or even a resident of a condo association. So with that, like kind of dropped right in the middle of the conversation, tell us what you mean by that, and how does that kind of tie into our topic of today?
Sure. Thanks. Thanks first of all for the opportunity to be with you guys. Look forward to the discussion. I don't want to come off too heavy-handed there. I might edit that phrase to say very challenging instead of terrible, but I guess that depends on the circumstances of the person. We're at kind of this strange inflection point, I feel like, in the community association world where board members who are, volunteering their time, volunteering their energy, have been met with a really nasty combination of challenges, particularly in Florida, with regard to rising costs, with regard to new legislation, a lot of anxiety in the marketplace about property value and kind of long-term viability and insurability. And I think that's kind of trickling down from the board level to the membership, to the residents, right? There's, I subscribe to a bunch of different blogs and I read the, local newspapers, and it's been a bit of doom and gloom for the last couple of years, talking about, are we in a bubble or not? Is this kind of the peak of some sort of condo, collapse, or is there some pending collapse that's going to happen? I sure hope not. But there are definitely some very difficult challenges that need to be worked through, and kind of this, um, generational divide between kind of the old days what I'll call pre Champlain Tower South to the world we're living in now. In Florida, we've had some new legislation that has come around in the last couple of years that has required reserves, which are kind of the financial resources that associations use to pay for their major projects. Whereas in prior years, those were required in a sense, but they could be waived by a vote of the members. And the biggest thing that's happened in the last couple of years is that Florida's caught up with the rest of the country and said, we're not going to allow associations to not put money away for these very critical assets. So that's kind of one aspect of it. The other is just the kind of ever-present risk of hurricanes and natural disasters that has driven up the cost of insurance. So if you're in an association these days, the cost of living feels a lot more expensive than it was not that long ago. What I think is actually happening is that this really represents the true cost of ownership, at least from the reserve standpoint, that maybe people didn't appreciate in the past. They were used to passing a special assessment or going out and borrowing money for a project when it became unavoidable, right? Our roof is failing, we need to replace it. We don't have any money in reserve, so sorry everybody, we're going to pass the hat. We need to have a special assessment. And if people weren't in favor of that or didn't have an appetite for it, maybe they would go to a bank and try to borrow funds for that. And that's now changing. Right now, the true cost of ownership is going to be spread over the generation of all the owners who come and go through a property, who are all going to be asked to pay their fair share of the cost of deterioration of those assets, not all at once, like some, kind of nasty game of musical chairs, which is kind of traditionally what happened a lot. So yeah, that's what I meant by that. Of course, no two buildings are alike. Some are much better off than others. But yeah, I think we're going to talk a lot about all that today.
Yeah. So, and I think, obviously it sounds like Florida is kind of ground zero for this matter. Um, you had a great story about what I think you called the Del Boca Vista mindset. And there was, again, like, you're full of these catchphrases, and that some of these residents are operating under the mindset they're not buying green bananas anymore. And so talk us a little bit about kind of how that feeds into this situation. And then Dan, I want to talk to you about you on the front lines of this, and how you're talking through to boards and residents about these very issues they're facing.
Yeah, so those fans of Seinfeld, the old Seinfeld show, might remember that reference to Del Boca Vista. That's where I think it was Jerry's parents moved down from New York to Florida, and it was just this stereotypical story that is actually very, very common. You get people who move to Florida to retire and live in the sunshine and enjoy their golden years, so to speak. Um, the problem with that is that people kind of in that demographic who are not in the workforce anymore, maybe they're on a fixed income, they're living off of retirement, and their personal kind of time horizon and how they're thinking about their property value and what they want to get out of it tends to be a different mindset than somebody who's in their 20s, 30s, 40s, who's maybe buying their first home and wants to raise a family there. So I think historically you had a higher than well, a large population of people, let's say, a large demographics of entire associations that were kind of that mindset of like, hey, you know what, this is not going to be our problem, right? We're getting a reserve study or some kind of information saying we need to plan on a 30-year timeline, and that hits differently for people who are in their 60s and 70s than it would for people who are much younger. And the problem that you run into is that if every generation of owners who live in a property, or at least a sizable percentage of the people who live in those properties, have that same mindset, they come and go, the building around them, the community around them is still aging and deteriorating on its own. And if nobody's kind of picking up that financial tab by paying into a reserve account, then you kind of run the risk of these, major expenses all happening all at once, and you've got this very unlucky group of owners who happen to live in the property at the time, the elevators need to be modernized, or you've got a major, painting and waterproofing issue, or a roof replacement, or a combination of all of those. And all of those people are going to be stuck with paying the tab for the prior owners, right? Everybody who came before them, largely who got the use and benefit and value of those things, but were never charged accordingly in the form of, budgeting on an annual basis for those. So that, that mindset of it's going to be somebody else's issue, eventually you run out of time where the building absolutely needs work done. And if they're in a financial hole, it becomes very difficult to climb back out of that. And so they have very few resources at that point in time.
So Dan,
Yes.
does this sound familiar? Are these some of the conversations you're having to educate folks and remind them that while they're still on this planet, like they have to be good stewards of these properties?
Yes. And two words that I kept hearing Will say over and over and over are two words that start with R: replace and repair. With that being said, if you could repair and replace these things in a structured manner, and what I mean by that is having transparency and communication to your board members, letting them know about this reserve study, and by future planning of this stuff, this is going to cause peace of mind throughout the community. The last thing you want to do is do a surprise special assessment, because no one's going to be happy about an unexpected bill. So as long as you're constantly reviewing the budget and you have a plan and a good property manager in place, this should alleviate a lot of those things, JJ.
One of the things that we come back to a lot is that I feel like personally people are more afraid of the unknown than they are of bad news. And so if you have residents or board members living in a property that they kind of intuitively feel, hey, we're behind, we're not where we should be. I'm nervous that if we go through this process of examining where we are, that's going to be catastrophic. They have to just kind of go through the motions sometimes, go through the steps of actually finding out, and then maybe realizing, hey, it's not as bad as we thought, or maybe we have more options than we thought. Yes, we're going to need to gather some more money more quickly. Maybe that's a special assessment. Maybe that's a combination of an assessment and a dues increase and a bank loan. But I think a lot of buildings are very hesitant to even ask the questions and go through the investigation, and that never leads them to a greater outcome, right? So, it's like going to the doctor or something like that. If you're nervous that you're in bad health, sitting on the couch and just, assuming the worst is never going to help you out. But if you go out and seek out the opinions and go through the steps of being diagnosed, at least now you know what you're up against and you can make a plan. But I feel like there's this, unfortunate tendency for people just to kind of bury their heads in the sand and say, woe is me, and hopefully it'll be somebody else's problem by the time I'm out of this place. And that's just not a substitute for a good plan.
So it sounds like maybe you've had folks that you've met some resistance maybe in doing repairs and replacements, because anyone who's a homeowner knows, like, hey, the longer you wait to deal with the problem, the more expensive it gets, right? It just metastasizes. So how have you been successful in sort of getting them to see the light, so to speak?
Well, I think obviously I communicate with them as well. I do speak to boards on a daily basis, but another huge tool, and you heard Will speaking about that, is the reserve study. This reserve study basically lays out projects, not just what you're thinking about right now that's might be broken or does need to be repaired, but it lays out all the projects that need to be done over the next couple of years. So with that being said, rather than waiting to the last minute, boards could start planning accordingly and really start saving their reserves and so forth, and acting responsibly rather than just doing everything at the last minute.
I was going to add on actually one thing to something Dan said earlier about a special assessment. And usually there's nothing special about a special assessment. It's the inevitable result of not having planned and saved money up until a certain point, right? There are cases where a special assessment is, a real justifiable response to a situation, right? Like you have a hurricane that comes through and you have to pay your insurance deductible, right? And that's a huge sum of money. You couldn't have necessarily predicted that or known when it was going to happen. There is a time and a place where a special assessment is the appropriate financial response, but it should not be a crutch that buildings lean on as their primary way of paying for something, right? That's plan B or plan C, right? You want to charge your owners accordingly in the annual budget, making sure that everybody's paying their fair share, right? It's not just all at once when the music stops. So yeah, that's just, we hear about special assessments all the time. We have clients that have gone through many of them over the years, and it's just a very toxic environment to live in, right? When I first started working in Florida a long time ago, I was doing an inspection of a building and kind of got stopped by this woman who just was clearly like curious about what I was there to do. And I explained, okay, well, I'm a reserve specialist. I'm here doing this reserve study. I'm inspecting the property to help you guys identify what you're going to have to do and what it's going to cost, so that everybody's aware of that and there's no surprises here and you can make an informed decision. And she's like, I wish they would have done this years ago. I just moved in. I think she had been there, a matter of months. And if I recall, she was a widow, right? She was on her own, just relocated down to Florida to be near her, kids and grandkids. And she said, it wasn't a month or two that I had lived in this building. I got a, notice on the door or under the door saying, your special assessment is due soon. And she was just kind of blown away. Like, well, what? I just got here. I'm still unpacking my boxes. What do you mean a special assessment? And it was just a complete shock to her that, why was this stuff never taken care of? I mean, obviously the building has a coat of paint that needs to be repainted every so often. Why was there no money for this? Right. And that's just, who knows how many countless times that's happened. And I think that's one of the major pushes of this legislation and this change of just how things are done, is making everybody more informed about the financial position of an association, so they can be a more informed buyer, they can be a more informed resident, they can know what they're getting themselves into. So yeah.
I like that phrase, JJ. Nothing special about a special assessment.
Well, my takeaway from hearing you guys talk about this is like, I think the special assessment is I loved what Will was saying. That's like, this is a crutch, right? I mean, I don't love that, right? I like, if it sounds to me like if you are constantly doing special assessments, poor financial planning, probably need to talk to your banker, probably need to sort of figure out how to have a consistent stream of revenue, whatever you need to do to kind of retool, reallocate the dollars flowing into the reserve accounts. But, my other sense is that, like, Dan, Will, if you're talking to a board member who's maybe kind of curious about whether or not we should get a reserve study, or like thinking about, seeking a new financial relationship, I would think if I hear special assessment over and over again, that's like a red flag, right? Okay,
Yeah.
so I want to jump. We started talking. We got into the reserve study, and I know that that was something that we previewed kind of at the top of the pod, and Will, another phrase that I think you used, and this is maybe even a great way for our condo associations and our various condo owners to sort of frame it to board members, if there's resistance, is like, you describe this as like a credit report for the association. I think that's a really strong analogy. And so why don't you just for all of us that are still in that Del Boca Vista mindset, help break it down for us and kind of in simple terms. What exactly do you mean by that?
Yeah, I mean, it's not a perfect analogy, but it serves a purpose, which is that, we're looking at the total financial picture, or at least the total financial picture of the physical needs of the property, right? We're understanding a timeline of future expenses. We're looking at future obligations. When are they going to have to spend money? Which, kind of is like a credit report. You're looking at, okay, how much debt did you already have? What are your payment obligations going to be? Well, you can very easily map that onto a building and looking at the age of its assets and its replacement costs for those things, and you can define kind of what the future needs are going to be. Then you look at the present day and you say, how much cash do they have? What is their current financial position? We use a metric called percent funded to measure that. It's on a 0 to 100% scale. and I can make a determination after looking at the future timeline of expenses and looking at the cash on hand. It's a way for us to say, okay, here you are as of this fiscal year. Um, we calculate a number of what you should have, what's what we call the fully funded balance. It's kind of this theoretical number saying, in a perfect world, if you had planned from day one of the building and had very good numbers for life expectancy and cost, this is where you should be. Now, let's say that's $1 million. If we look at the balance sheet for this building and they only have $200,000, they are 20% funded, right? They're 20% of where they should be. So the takeaway there is that they're going to need to step up their funding of those reserves in order to get back on a track to being more financially strong. So that percent funded number for me is like a credit score for the building. It's not a perfect analogy, but it gives us a snapshot in time that it kind of indicates, what kind of risk are we talking about here? So if I'm a potential buyer and I'm looking at 5 different condo buildings I want to buy into, and I know the percent funded number for each of those, that's just a nice data point for me to have in my decision-making process. Same way a lender might look at 5 different potential borrowers and say, okay, well, what are their 5 credit scores? Which one is the strongest, one for me, the lowest risk? That's the one I want to do business with. So, I think a good reserve study brings all that together. It's the physical reality of the property mapped onto a financial timeline paired with a judgment call about how well prepared they are to deal with those inevitable expenses. So it's a really powerful tool for the current members, right, to know what position they're in now. Like if you get a credit report back and it shows that you've got, a low score and you have some, some dings on your credit report, well, you want to fix those. You want to improve that position because that'll make you stronger going forward. Or it can also shine a light on the fact that you're in great shape, right? We have lots of clients that are in a strong position, and we encourage them to kind of go with that, advertise that. If you have potential buyers inquiring about your building, that's a feather in your cap to say, look, we have cash on hand. People who live here are going to be much less exposed to these risks compared to other properties. So you can almost lead with that as a selling point for the building should you be in that kind of strong range. So yeah, that's again something that resonates with a lot of people when you put it into those kind of personal financial terms.
So I know that these reserve studies, they're fairly lengthy. I think, they could be anywhere like 120 pages. It's a novel, or, maybe a YA novel. But, Dan, let's pretend I'm on an HOA board. I'm a board member. I'm, I need some financial guidance, right? And I'm maybe I'm even looking around for another option. And I'm going to sit down with you and talk through my reserve study. You look at these reserve studies all day long. Help me understand, what's the banker perspective on it? What are the things that you look at, that you zero in on, that these are the things I'm going to want to talk to a potential client about?
Well, I think both you and Will kind of nailed it. When a board member or someone who is looking for a loan, unfortunately, they kind of have their blinders on, JJ. They're kind of looking at the current situation that's going on. Hey, I need a new roof replacement. They're not looking at the total picture. So whenever we do a loan for a client, we're trying to put them in the best possible position. We're not just worrying about one simple snapshot. We're looking at the big total picture. So to kind of answer your question, I think a lot of questions that originally come up is so focused on that initial problem. But when you start peeling back the layers and so forth, and you're like, hey, you might have a roof project now, but you're going to need to do some siding in X amount of time, maybe some pavements, whatever the case might be. That's what the bank is trying to do, put them in a better situation than they are now and try to educate them a little bit, because it's easy for someone to just come up to us and say, hey, I need to get this done right away. But as a banker, I want to put them in the best position, just not now, but years down the road.
I love that, because I think that, really speaks to both like the consultative approach that like you and Will bring. And obviously like these are people that, they have a fiduciary responsibility to the organization. I think, Will, something you had mentioned when we first spoke was, whether you like it or not, like you are a member of a corporation and you are overseeing an asset. the asset being this. So like, I don't know, maybe you guys can kind of give some examples of how maybe you help people see the light a little bit and help put them in a better financial position just by talking them through the reserve study. I'd love to hear it, you know?
Yeah, sure. I mean, I think it's a point that really needs to be driven home a lot, which is, you move into a condo building. I'm just going to make up a name. Let's say it's, Ocean View Condominium Association Inc., right? It is a corporation.
Sounds like there's like 17 of those in Florida, right? Like,
Probably more than that, yeah. Um, but you're becoming a member of a corporation along with all of your fellow owners, right? Think of them as your business partners. And just like any business, you have revenue, right? That's the assessments, the money that you collect from the owners. And then you have expenses, right? You've got to pay your staff, you've got to pay your insurance, you've got to pay your janitorial services, and so on and so forth. And you have a board of directors, right? They are like the board of directors for a company. They're charged with steering the place in the right direction. And it's not a for-profit business model in the sense that they're trying to, sell goods and services, but their long-term value proposition, right? What they're trying to achieve is an increase in property value relative to the market, right? They want to maintain their position as a competitive option for potential buyers. Those are in a sense their customers. And so I think what people kind of lose sight of sometimes when you move into a building like this, and really we're talking a lot about condos, but this extends to co-ops and HOAs as well. But I think it's most important in condos. When you buy into a condominium association, you basically own the airspace within your walls of your unit, and everything else outside of that, more or less, is owned in common with everybody else. So you have a vested interest in the entire common area being in good condition. The lobby, the elevators, the swimming pool, the tennis courts, right? All of that stuff contributes to your property value in some way. It's not just your unit and your particular view from your balcony and your square footage. It is what you own in common with everybody else. And so when we start talking to boards of directors and pointing this out, they're like, hey, you have a fiduciary duty to the members of this corporation to uphold this property value and run this place in a business-like manner. Sometimes people's eyes get very wide and they're like, well, I just got on the board because I wanted to tell my neighbor to turn their music down. Well, no, if you think of it this way, even a moderate oceanfront condo in South Florida, say you've got 100 units. If you've got an average price, let's say it's a nice building, $1 million, price per unit. To me, that's something like $100 million asset, not even counting the land that you're sitting on, right? So when you start to talk in these kind of business-like terms, I think that's really important to drive home the need for good planning, for risk management, for leadership, for just sound decision making, all the stuff that any business should try to prioritize. Same goes for a community association.
so do you see that? Do you see that when it's framed in this as like a business that kind of gets people to see the light a little bit?
Yeah, and I think one important thing as I'm listening to Will talk is that these are board members. These are volunteers at the end of the day. It is so critical for board members to know the tools that are around them. They have people such as Will, who could be a great financial consultant to them. They have lawyers who specialize in just HOAs or even have a great HOA banker. So just knowing the tools that are around them, they are not here by themselves trying to navigate this. Some do, some are independent, but just know there's plenty of resources to help them out to get to that path.
So from like a board culture perspective, because I think a lot of the success of successfully, I think, implementing a reserve study, getting the full value out of it, ensuring the long-term, structural and financial soundness of this building. It is executing, right? And so, something you just touched on there is kind of board culture, and I think you also just mentioned sort of having this cadre of centers of influence or like, do you notice that like boards that have, hey, like they got somebody like Will, they got somebody like Dan, they got a good real estate attorney. Hey, these are the folks that seem to be in good spots versus maybe the other. I don't know. I don't want to assume, but it's kind of what I'm hearing here.
Yeah, and I think there's different boards, case by case, obviously, but some boards are super active. They have great participation numbers and so forth. Um, Transparency and communication, I mentioned that previously, is just huge. But if a board does not have maybe the best morale, JJ, I have a couple ideas. Maybe instead of just doing Zoom calls, have an in-person meeting. Get to know your community members and board members a little bit better, or potentially even have a event at your community. It could just be a meet and greet to get to know some of the leaders and so forth. And this way you get to know your community, get to build up that morale a little bit, and hopefully turn the page a little bit.
So,
Yeah,
Will, do you?
I would agree with that. I think it's really, really important to have maybe not a sense of camaraderie, but at least some mutual understanding that, hey, the board is not the enemy, right? They're residents just like everybody else. And, they've been elected to do a difficult, often very thankless job, takes a lot of time. You don't get paid for it. They're not the boogeyman. And we see this a lot when things are going badly, that there's a lot of blame, aimed at the board. And we just think, okay, why, well, we'll elect a new board who are going to give us what we want. And let's do that and, throw these guys out. And then the new group gets in and they're presented with the same information. And it's like, okay, it's not the board's fault. They're, my experience working with boards for, almost 18 years is that almost all of them have their hearts in the right place. They're trying to do the right thing. They have a sense of responsibility. Um, they may not have all the tools and skills, and that's where you were talking about, you build that all-star team around you. You have a great attorney, you have, very often a professional property manager, you get a great insurance agent, get a great banker, hopefully a good reserve study provider. Lean on these people who are experts in those fields. But at the end of the day, to be a good board member, I think does require some leadership, some communication skills, the ability to make difficult decisions. Um, we see, unfortunately, cases where the board kind of huddles up and they just say, well, we're going to do things the way we think is best, which not always have the best interests of the building in mind. I always get very nervous when I work with a community and they say, well, I've been on the board for 10 years and we've never raised the dues. And they're thinking that's a good thing. And I'm thinking, well, okay, in the last 10 years, almost everything has gotten more expensive, right? So if your dues have not increased at all, but I know your insurance bill has increased. I know your utilities went up, your payroll costs went up. Where are you cutting from that you're able to keep the revenue the same? And usually, unfortunately, that means they're not funding their reserves properly. So, I think being a good board member is being a steward of the community. It's being honest, transparent, steering people in the right direction, um, and being willing to make those tough decisions, which is not always going to make you very popular.
I agree with that. It's not an easy job to be a volunteer board member, so.
It doesn't sound like it. Um, so I want to come back to the sort of the topic that we talked about at the top of the call, and as we led off here with the the boogeyman of the blacklist. But I think we've spent a lot of time. We haven't, I think, specifically spent a lot of time talking about Florida, but I think Will, I think a lot of your experience. I mean, you're based in South Florida. I think a lot of the examples you gave are very much related to Florida. If we kind of pan out a little bit, because I think when we were talking about this topic, prior to recording, there's Florida is kind of like maybe the tip of the spear when it comes to what's happening. And I think we sort of talked about there's this perfect storm of both the kind of rising costs, above the board, insurance costs, all kinds of everything's their costs are rising, coupled with climate change, and climate change being an instigator for some of these rising costs. Uh, can you let us know sort of what is the rest of the country looking like, and how should people who, while there maybe isn't this legislation that Florida has recently passed, but maybe there's other states or communities that are kind of looking at uh, similar approaches, and what would be helpful for other folks around the country?
Sure. Well, yeah, so we do have a national presence. Our company, Association Reserves, we operate in all 50 states, and we've got, kind of these insights that we see everywhere. And I would say that, yeah, Florida is kind of one of the more extreme examples of this rising cost. But look at the other coast, look at California, with wildfires, look at, ice storms and tornadoes and, freezes and all the different types of natural disasters and these phenomena that are occurring everywhere. All of that is driving up the cost of insurance. And if you remember that, insurance companies have uh, risk in all these different places, they can be affected by a storm in Houston that drives up the cost of what they want to charge people in Tennessee, right, or someplace else, because collectively as a company, and I don't want to get too into the weeds. I know a lot of the bigger insurance companies are kind of subdivided where they'll have a State Farm of Florida, right, which is kind of its own thing within the umbrella of State Farm insurance. But what's true, I think, nationally is that there's just this, more frequent phenomena that are occurring, um, you know, uh, doing more damage, more financial damage than we see. And that just has a trickle down effect that it raises costs on everybody, even if you don't live in that place, right? So just using Florida as an example, last several years, we've had some really major hurricanes that have done damage to, fortunately, some of the lesser populated parts of the state. And I don't want to be insensitive. Of course, there's tragedies that happen in each of those storms, but um, if you live in Miami, knock on wood, they haven't had a major hurricane directly hit Miami in a long time. But the same insurance company that you have as your property in Miami might also insure a lot of other buildings elsewhere in the state. And because they're taking a loss there, that's still going to affect you. So nobody's really immune to this. And I think that that's just unfortunately the trend we've been seeing is that that's not getting any easier. As properties are just more susceptible to these high risk zones, that's not a trend I don't think is going to reverse anytime soon.
So Dan, and I'm going to start with you, and then I want to close with Will. Like, as we round out the end of the pod here, um, knowing that this is something that is potentially affecting a lot of people, or they should be prepared. What's kind of one piece of advice that you would give to associations or board members right now? Just one thing they could do to be prepared, or maybe be better prepared.
That's a great question. If I had to answer that, and I know this is repetitive on my previous answer, I think let the experts help you. There's experts, as I mentioned, whether it's a lawyer, financial consultant, or something, just know you can have a good team around you. And by having that team, you're not alone. You don't have to do this alone and so forth. It's a lot of responsibility. As Will mentioned uh, previously, this is a multi-million dollar business. And for you just to step in there and think that you have to handle this all by yourself, my one piece of advice is lean on your property manager. You pay these management companies, know the other tools that you have around you. And honestly, sometimes it just takes a little bit of a time, but you'll get there.
Will?
Yeah, I think it's just what we've been talking a lot about today, embracing this kind of business-like mindset. Remember that owning a piece of property in a community association means your financial fate is tied up with a lot of other people, and you guys collectively should be making good financial decisions to secure your long-term outlook. So yeah, leaning on the advice of experts, kind of almost doing like a SWOT analysis, right? What are your strengths and weaknesses, your opportunities, your threats as a property? What do you have that's an asset that's beneficial? How do we communicate that to our residents, right? If we have weaknesses or we have threats, let's take those head on, right? You can't just bury your head in the sand and assume that the property market is always going to go up no matter what, right? Especially in Florida, it's very much a history of boom and bust, right? If you look at what happened from 2005 to 2008, 9, 10, a massive cratering of property value. And then we've been on this kind of nice upward trajectory since then, but a lot of people are nervous. Hey, is this going to be some sort of a peak? And are we going to have another crash? We certainly hope not. But whatever happens, the properties and the communities that will be the strongest coming out of it will be the ones that made the best business decisions, right? That their goal was not just to keep the dues low or to say we can't afford this and we're going to throw up our hands and just, panic. No, you can look internally, communicate with your residents, find out, what is the true cost of ownership. And I think it has to be said, unfortunately, in some individual circumstances, people may not be able to afford to live there. Okay. And it would be a huge mistake for an entire building to play down to its lowest common denominator of residents who are barely able to make it. That's unfair to all the other residents there. But I see this kind of decision making, this mentality, a lot of, catering to the people who are, in the worst financial position. That's just unfortunately a difficult business decision you might have to make. I've been using the phrase unfortunate economic reality because it's all of those. It is unfortunate that there's some people who bought into buildings based on the expectation that the dues were going to be a certain level and that they could afford that. It's economic, right? It's dollars and cents. There is a financial reality to living in these properties. Roofs don't care about the people that live underneath them. They're just sitting there in the Florida sun, aging and deteriorating every day, and they cost what they're going to cost. And it's, up to the building to deal with that reality, right? That's that final piece, is embracing it, taking a hard look at the position that they're in, trying to dig themselves out of a hole if they're in one, or if they're in a good financial position, leaning on that, marketing that, using that as a selling point for the building. We have a bunch of clients that have kind of looked around the last couple of years and say, you know what, we're actually doing okay. And our owners are not suffering. We're not experiencing this, sensation or this panic mode that a lot of other buildings are. So yeah, dealing with that, I think being a board member, like, tying it all the way back to the top, I would retract my statement saying it's terrible. I would say it's very challenging, but, challenging times require good leadership, and I think that's where really good boards need to step up and lead their communities out of this this kind of challenging period we're in.
Thanks, Will. So to reiterate, teams, having a good team,
Oh, yeah.
team of advisors. And Will, I love what you're saying about sound financial mindset, business mindset, because it's a big business, a big investment. So Dan Selzer, not Seltzer, Will Simons, thank you both for joining us on Pick Up, and we'll see everybody next time. Thanks so much.
Thank you.
Thank you. See ya.